All right, so let's get the webinar started. So today we're going to be doing a live underwriting session. So all about apartment syndication. You're going to be able to take a little bit of a peek behind the scenes as Danny Randazzo, one of our managing partners with PassiveInvesting.com. He's going to be underwriting a real deal live right in front of you here today, and we're really excited about it. And then he's going to be helping you identify potential flaws in various apartment syndication underwriting models as well, so you can be kind of aware when you start to use other models and things like that. What are some things and some pitfalls that you should be looking for there? So before we get started with that, before I turn it over to Danny, I want to mention two things. So first off, when we get finished with this webinar today, you'll have the opportunity to go and register for the next webinar, which the next webinar next week is going to be all around the coronavirus and the impacts on multifamily investing. So you'll want to make sure that you stay tuned for that one. And we'll give you the links to be able to do that as well. And then we also wanted to mention, for those of you who are interested in investing passively in apartment investing, you can go to PassiveInvesting.com and register to be one of our investors there. So here's the website here. Just go to PassiveInvesting.com. Right there on the top right-hand corner, you'll see a button that says join the Passive Investing Club. When you fill out that form, I'll jump on a phone call with you and discuss your investment goals to see if you're see if our group is the right fit for you and your goals that you have right now for your portfolio. So, all right, without further ado, I'm going to turn it over to you, Danny, and let you kind of give a little bit of a brief bio about yourself, and you can dive right in to this apartment syndication underwriting that no one else has done before. So I'm really excited to see this, and I know many other people who are on are looking forward to it as well.
All right. Well, good afternoon, good morning, good evening to everyone. We have people from all over the world on today. A little bit about myself. My background is actually in financial consulting, and I worked with multi-billion-dollar companies to improve their business operations and ultimately their cash flow. So if they had the need to implement a new software system or change the process of how humans were actually working in the office or what they were doing, we would come in with a small team and optimize, standardize, and roll out new procedures to help them become more efficient, not only from a people perspective, but from a technology and a process perspective as well. So did that for many, many years, and then started to have a real desire to have more control of my time as my wife and I began to spend a lot more time together and focusing on our family. We were both very busy, traveling, working a lot, and we realized that having assets such as real estate and specifically multifamily assets is one of the greatest ways to produce income and give you the ability to control your time and do the things that you love. One fun fact about myself, I actually lived and worked in the United Arab Emirates for about a year. So shout out to my close neighbor, Omar, there in Saudi Arabia. I hope this webinar goes well and you get some value out of it, inshallah. So without further ado, let's jump into the reason we're all on this webinar. I'm going to try to keep things brief and short today, and allow for Q&A at the end. I know that's really important. So there may be some things that I give as like a homework assignment to study or figure out on your own, but I'll be sure to call those out as we get into things where you can kind of go out to the internet or watch another video to get a deeper dive if you don't know some of the basic fundamentals. I really want this to be focused on some of the advanced techniques about underwriting and how to be conservative versus too conservative. So if you have been hearing or seeing a lot of deals not work out, sometimes it's because of your underwriting. So without further ado, the format for today is going to be kind of starting with an underwriting model, and we're going to start from scratch. So for those of you who are not familiar with the MFIN group, we do have a basic underwriting model that Dan and Melissa are able to provide. So reach out to them if you don't have it. I believe it's also, available for download on the website. So coming into an underwriting model, most of you, this may be familiar. It may be the first time you're seeing it, but basically I want to call out some of these tabs along the bottom. For today, all we are going to focus on is this inputs tab. This is really what drives the underwriting process. And once your inputs are in, you can jump over to these other tabs and really see how your asset is modeling out, what sort of metric and IRR, cash on cash return, are you looking at honing in on. So for this example, what we're going to do is we're just going to underwrite a property from scratch. So we're going to populate a couple of things off of here. So the first one being the kind of purchase price that you are targeting to go into the asset at. You know, when we're talking about $10 million plus multifamily properties, there is typically a broker kind of BOV or broker opinion of value. They may also tell you a certain price per door that the property is going to trade at or should be trading at. So that being said, this property that we're looking at, it's, you know, the guidance is kind of around 19 million, let's call it. And so for underwriting purposes, I went ahead and put in 18.9 million, and I kind of tracked the whisper price at about 19.44. So we'll see how that works as we get into the underwriting. So step one, when underwriting a deal, you're going to need to populate the unit mix information for all of these units, which is going to drive your income for your T12 or the seller income, and then your stabilized income once you take over the property. So when you do this, the first step is to look at a rent roll. And I'm just going to pull up the example of this rent roll here from a property type. And the one thing that I use very frequently when underwriting is this pivot table. So what I like to do is insert a pivot table to summarize the unit types. The hard part is these rent rolls, as we know from looking at hundreds of deals, are all very different from one seller to another. So sometimes you don't have a clean rent roll to give you a summary view of how many 2-bedroom, 2-bath units are there that are 1,065 square feet. So if I just select that, it looks like we have 34 of these units and they are all 1065. So a couple of options here to get a summary view. Number one, if you have CoStar access, you can pull up this property and look it up in CoStar, and it's going to tell you how many 1-beds, how many 2s, how many 3s. Number two, you can use a broker OM. They're going to tell you how many 1-bedrooms, how many 2s, how many 3s. And the best source that I like to use always first is the rent roll, because it's going to tell me, you know, maybe some of these 2-bedrooms have been renovated and there's a -R, or it'll say 2-bed, 2-bath renovated or reno next to it. And so that's the first step, is you need to break this down. A good way to do that is using a pivot table. I'm not going to go through the process of doing that. If you need to learn how to use Excel, there's some very good YouTube videos out there on basic functionality, basic pivot tables, basic formulas to use. And so with that being said, I have went ahead already and calculated these unit types and the quantity of units based on their size. So I'm going to cheat here, and I'm going to copy and paste my unit mix and prices over just to keep things going. So we have gone through our rent roll. We have identified that we have 34 2-bed, 2-baths that are 1065, and the market rent is $1,100 a month from the seller. So again, if we go back to these unit types, 2-bed, 2-baths, right? We have 34 of these units, as you can see in the count here at the bottom, 34, and they are all 1065, and the market rent today is $1,100. So that's where in our underwriting model, the 2 2s, 34 of them, they rent for today $1,100, and the square footage is 1065. So these numbers I'm going to remove for the moment because I don't want to get us off track there. Let me pause and just see. So yes, we will get you access to this. Where can we find a link? Dan will share it at the end. Thank you, Dan, for answering and responding to those. We are good to go. So from the rent roll perspective, again, you want to summarize what unit type information is in there and get a summary view to populate your unit mix information. Again, you can get this from CoStar. You can get it from a broker OM. The best source of information is that rent roll. So learn how to do a pivot table if you don't know how to use one. The other important thing that I like to do is I like to look at some of this summary information here at the bottom of the rent roll to see kind of, give me a gut check of where the monthly market rent is at. What are they actually collecting? How much vacancy do they have? So this seems like a pretty well maintained, or excuse me, pretty highly occupied, 96% plus occupied property. And it kind of gives me a gut check as we move on to looking at and starting to populate our annual income and our annual expenses, all from the seller still. So with that being said, you're going to get the broker OM, which is going to summarize these high level expenses and income numbers for you. But again, the best place to look is in their actual T12 or trailing 12 months of operations. And so here, again, if you remember our gut check from the market rent information on the rent roll, $163,000 a month is what they said that they are getting. So 163,000 is where they were at in terms of gross potential market rent. So with that, that gives us a total, right, compared to their T12, they're at 1.96, and our numbers in our underwriting, 1.96. Beautiful. We are spot on and matching their numbers. So when I typically do this, I will minimize my screen in order to compare numbers. So if you see here, their total market rent and our GPR are identical. These numbers don't have to be to the penny identical, but I like them to be within a few $100. And that is going to give you, again, it's going to give you enough information to make a sound investment decision, because we're merely evaluating the seller's historical financials to see what their operation is, to give us an indication of how we could run the asset going forward. So a couple items that you need to pull out of here. So their loss to lease, if you look up here, loss to lease is minus 160. So we're just going to kind of input some of this information in here. Vacancy is minus 175,851. So concessions and adjustments, I'm going to kind of tally up a couple of these items here. And so you pop these in, 16,795. And let's see here. I don't see anything for bad debt, which, again, interesting, kind of a red flag a little bit, but maybe not. That could always be a question to the broker. Is there no bad debt, or what are they doing at the property with that? And so Then you have other income revenue. And you have 41,000 plus you have utility reimbursement, and then you have other eviction filings, late fees, garbage, laundry fees. So total other income of 145,598. So we're going to put that in. Again, this is kind of like a art and a science where you want to go through things, and again, we're looking to match these numbers up. So the effective gross income was 1,754 in our underwriting model, and they're at 1,755. I'm okay with that. I would always prefer our underwriting to be, if we're under, that's a little bit better. Again, you want the numbers to be close enough to give you an accurate measurement. So the other important thing to do is to review these numbers to make sure that there's no outliers. They all make sense. It takes some time to have a confidence in what you're seeing. And so the typical rule of thumb is to try to underwrite 100 deals. And that's going to give you the opportunity to know what number makes sense for a loss to lease, what number makes sense for a concession or an adjustment. These numbers to me feel a little bit light in the concessions. I know where this property is at. The area I would expect does have some concessions, probably a little bit more than 16,000 that we had in our underwriting model. And then the other piece would be bad debt. I know this area, I know the market, and zero bad debt doesn't make sense to me. So again, that's just like a little question mark. And usually when I'm underwriting, I'll keep a little notepad with questions, and I'll just write them down and then email them to the broker or address them in a phone call with the broker. So I want to keep going. This is the process that we go through. And again, it takes some time to get to the level of comfort of knowing what numbers make sense or not. Dan and I had previously done a 2-part webinar series about typical expense rules of thumb. And that would be a great video to watch as a reminder to the basic expense cost for multifamily properties. And we go into the detail about a cost being broken down at a per unit basis. So their payroll, as I read this, so total payroll expense, 206,385. So I'm going to put that in here as 206,385. And this price per unit is fairly reasonable. I think that could be a little bit high for the area. Again, the payroll, the number of people to staff a 144 unit property, I think this number is a little bit high. But again, it's something to think about and investigate a little bit further. And so I'm going to go through and get the rest of these numbers populated. So as I'm looking at this, you see repair and maintenance. So we're in the service contract section. So service contract 67,454. 67,454. General repair and maintenance, 12,308. That sounds very light. $86 per door. Again, just very surprising. Turnover expense, 54,000. This seems somewhat reasonable. Again, we went through in detail in our part 1 and part 2 series about these rules of thumb and ranges for what a multifamily property should have. So let's see here. Supplies, I would probably bucket these supplies because it looks like repair and maintenance type of items. I'm going to put this 24,000 into R&M. And so then you just jump up here and you say 24,000 plus, there we go. Advertising and marketing seems pretty light at 24,503. Admin expense 26,573. Admin 26,573. Management fee 49,000. $106. Total G&A. Total controllable. Got it. So I like to check my numbers as I go. Utility expenses, 79,000. $407. Insurance expense, 44,524. Property taxes, 270. $708. So all of these numbers should add up to 240, 259 is their total expense, and we're at 259,973. So we're $2 higher in our expenses, and that is giving them a net operating income of 895. Now, one thing you'll notice in our numbers that the seller did not include was this reserve item. We typically underwrite to always have reserves in here because it's a common lender requirement. So everybody is paying for these reserves, and that's why they are what we call top of the line number, meaning above the net operating income. If they were a below the line item, they would fall below and your NOI would be higher. And so some typical numbers that go below the line, your debt service, any sort of capital expenditures for the property that would not be considered turnover. And so when I'm going through this, like flooring improvements and hardware, lighting, unit renovation, a lot of these items here could be considered repair and maintenance items. Unless they're doing a big value add project, HVAC, you have to plan that you're going to have HVAC replacements. As you can see, it peaks in the summer months, especially this property is located in South Carolina, and HVAC is a big service item at those times. So the science, the art kind of to it, you need to be able to review these T12s and be knowledgeable to say, okay, these numbers that the seller is giving me for repair and maintenance seems a little low. Now that I look at their T12, it is a little low because they're hiding some expenses here potentially in their in their capital expense items. So again, you need to go through a lot of different underwritings to be able to identify when something seems incorrect or inaccurate. But for purposes of today, we're going to leave it as is. And then we are going to move to our side of things. So now how are we as the buyer going to operate the property? And we're going to look to populate this pro forma number. And so when you go into this detail, you need to evaluate comps around your asset. You need to evaluate your business plan. Are you doing renovations? If so, what is the new premium, or what is that targeted kind of pro forma rent you are trying to achieve? And the other piece that we take, the other step to ensure that our expectation of new rental rate is accurate, we also get our property manager to provide us a rent analysis of their own, so we can see, are we in sync that these 2 bedrooms in this area should rent for $1,200, or should they rent for $1,225, or maybe they need to rent for $1,150. And that's going to drive a tremendous amount of success or failure when you're underwriting a deal. These rents are extremely important to spend time on to get right in order to feel confident in your business plan. So one way that we're conservative, when we underwrite a deal, we never try to be the market leader in rent. And so what I would want to see for our comp analysis is that there's other 2-bedroom, 2-bath units that are similar in style and finish once we are done renovating the property, that we are in 3rd, 4th, or 5th position in terms of rent price. We never want to be the market leader when we're looking at rents. So that's a follow-up assignment. In addition to the pivot table, if you don't know how to do a rent comp analysis, you need to spend some time working with a manager to learn how to comp a property correctly, and then study the market. So again, if you're doing 100 underwritings, you're going to look at a lot of different properties to get these pro forma rent comps. And now that we have completed that step, I'm going to go ahead and copy over our rents that we are going to project. Okay. So in our business plan, we now have these new renovated rent premiums that we are able to achieve based on, of course, our comp analysis, driving the market, and having a third-party manager validate the numbers as well. So with that being said, you can see we're trying to get about a $200,000 rent premium for gross potential rent in the market. And we also have some basic fundamentals that we can update and change based on our pro forma. And so I want to just take a quick look at our model to see where we were at. So from an other income perspective, we have evaluated what the seller is doing with other income, and we've evaluated some techniques that we can implement at this asset. Again, these numbers take time to know what you're going to do at the asset. What sort of business plan can you implement? But for today's purposes, I want to just go through the spreadsheet itself. And so we're going to get about 167,000 from that. This loss to lease number is a little too low. So I need to go ahead and make that adjustment. And we have a stabilized loss to lease over here. I think we would be at about 2% for that loss to lease number. I think because we are going to renovate the units, we're going to get a lot closer to these market rents in the future than the seller is today. That's why there's a difference between these two numbers, and that's okay. That's a explainable story to tell investors. Is right now Yeah, the property today is trailing the market significantly because they have older vintage product. They don't take care of the units as nicely. And we're going to come in and renovate these units, and we're going to be able to get these rents because a place down the street is renting for $12.50, and our unit is going to be newer and nicer, and we think it's going to rent for $1,200. So pretty simple, kind of basic stuff there. From a stabilized expense standpoint, I'm going to kind of pick up the pace here and just kind of drop in a couple of these numbers that I think we would be at for the purposes of the discussion. So this one, we would be at about 155, let's call it. Contract services, probably about 70,000. Again, we go through a very detailed process, and we have our property manager validate and support what these numbers would be for the asset. I think, again, from a turnover and a repair and maintenance perspective, we should be able to get by with these because we're planning to renovate all of the units. So again, knowing your business plan is very important to what you're going to do from an expense standpoint. We have our management fee auto calculate. So if we were going to pay a 3% a property management fee, maybe you get 4% or 2.5%. You can just update that in the model to be based on your negotiated rate. The last item I want to cover from an expense standpoint is the property taxes. This is absolutely critical to your business plan to know what your taxable burden is going to be when you purchase the asset. So previously, the seller was paying $270,000 in annual property taxes. I know that this county in South Carolina reevaluates property taxes at point of sale. Some counties do it on a 4-year or 3-year cycle. They do not reassess you when you buy or sell an asset. But this county does. They do it at point of sale. And the rough rule of thumb is they will take 75% of the purchase price to become your new taxable value. And typically you will keep the same millage rate. And so what we've done is basically calculated what the assessed value would be and what the millage rate for that area is to come up with this new tax number, which I know is pretty darn accurate. But it's absolutely critical to, if you don't know what you're doing from a tax perspective, call the county, go into the county office, call a tax consultant. You have to get this number correct. Otherwise, it will kill deals for you. You'll buy a deal and you will be burdened from a cash flow perspective in not being able to pay your bills if your tax bill jumps significantly. So it's not meant to scare you. It is meant to say that this piece is absolutely critical and you must get it right. Sometimes your property manager can help you, but I would not rely on them for any help with your taxes or your insurance. You should speak to a professional to get quotes on both of these items, a pro on the insurance, and then talk to the county. Sometimes you can use the county website. They'll have a little calculator for you, or they will explain the reappraisal process. That being said, the other important piece to underwriting, now that we have our seller, the seller information here in the T12, and then our projected stabilized operations, you need to populate some of your standard closing cost assumptions. So typically closing costs are about 2%. It could vary somewhere between 1 and 3. These are just example numbers. Again, the reason why you need to underwrite and look at a lot more deals is to figure out where those numbers come in at. But 2% should be conservative. You should come in below that when closing a deal. Operating reserves, we like to bring in about 2% of the acquisition price. That typically covers you for about 4 to 6 months. But again, you need to understand what adequate reserves are for each type of property, and of course the business plan, the location, the quality of the asset, et cetera, et cetera. The loan assumption area here, we are not going to assume a loan. We're going to get a new loan. It's not going to be loan to cost. It's going to be an LTV. Currently, the market for agency loans that are 10 years right now, this is a 10-year duration loan or 120 months. Somewhere between 70 and 75% LTV seems reasonable. Again, talk to a professional about where you think rates are at. Today, I think it's about 3.5% for a good deal in a great market. So these numbers in your loan assumption, you need to talk to a professional about that. I'm going to skip any sort of refi, any sort of mezzanine, because again, I just want to kind of stick to the fundamentals of it. And you have rehab assumptions. So I said this is a value add project. It's going to take us 12 months. Maybe it's going to take us 16 months, but for 144 units, we should be able to do about 10 to 12 a month and get through 144 units. We need $100,000 in exterior CapEx budget for our renovation plan, and we need about $5,000 per door. Again, this is something you need to speak with an expert about to evaluate what the renovation time would be. I highly recommend you get a management company that has a lot of experience doing value add projects if you are new to doing value add. I talked about the management fee. I talked about the taxes, your annual rent increase. You know, for the markets that we buy in, typically 3% on a rent increase and 2% on an expense increase is pretty conservative. Most of our areas like a Raleigh, a Charlotte, and a Greenville are seeing higher than 3% annual rent increases projected for the next 5 years. But you need to know where your market is. Maybe you're in a more tertiary market and you think you're not going to get any basic rent increase. You're just going to have expenses go up and rent go up to match the expenses. Well, just set these numbers to where you need them to be at. Vacancy rate, once you're stabilized, like I said, this asset is a stabilized asset. It is higher than 95% occupied right now. So having a 5% is conservative. Loss to lease, conservative. Concessions and bad debt, again, conservative. Exit cap rate, we are exiting right now at 50 basis higher than entry, meaning we're purchasing this asset at about a 4.54 cap rate. To me, for this deal, this market, the price seems a little high. The cap rate is a little bit low. And so that's something you just need to kind of play around with. Can you bring this price down to maybe 18 million and it brings the cap rate up on your entry, and then you would exit at about 50 basis higher. That's like a rough rule of thumb to be conservative, exiting 50 basis higher. And that really runs us through the basic fundamentals and some of the advanced techniques. So again, pivot tables on your rent rolls, extremely helpful. Knowing your taxes, your insurance, and your lending or financing, extremely important. Talk to a professional. Number 5, go through a ton of underwritings in order to know what numbers don't make sense at all, what seem to be outliers, not only from a rent roll perspective, but a T12 perspective, and from a stabilized perspective as well. Have your property management company help you. Ideally, they manage other like-kind assets in the area. And with that, I'm going to pause for just a moment, take a drink of water, and then I'm going to get to some of these questions. So in the chat box, let's start to address some of these questions. While I am addressing some of these questions, Dan, feel free to jump in if there's anything you think I have missed in the underwriting section. But before we do that, let me jump to some of these questions and make sure we'll share it at the end. Jumped on a few minutes late. Premium members. All right, that's a basic question. Why is 9?
There are also a few questions in the Q&A section too.
Okay, I'm going to jump over there as well. Why is 948 highlighted? Let me see here. I think that was in the T. Was it in the T12? This is just how the seller sent it. So again, great question. I would probably follow up with the broker to see what was going on and if that's something strange, something whatever. You know, data usually doesn't come across super clean, depending on the type of seller. If it's like a mom and pop seller, you may get a couple of scanned pieces of paper or an Excel if you're lucky. So know the type of seller you're dealing with and the data that you expect to get from them. Where do you get your benchmark cap rates from? This data, Brian, you can get from like a Marcus and Millichap quarterly report for the market and the submarkets. We use CoStar to get actual sales transactions, and then we come up with our own comp set to comp it. And you know, we typically evaluate I would say about 100 deals a quarter in the markets that we look at. And so we know if a 4.6 cap is a little too low, we know if a 5 cap is a little too high, what could be wrong, why, what kind of questions would we have? So you need to know the market, you need to be studying it and evaluating a lot of deals to be able to say the benchmarks make sense. Again, even if Marcus and Millichap knows the market really, really well, I would still want to have like a handful of comps that I can trust to give me an indication on cap rate and price per door and things like that. When backing into the rents, is it better to use a rent roll or a T12? I use both. So I review the rent roll to make sure that it makes sense to me. And then I cross-check the T12 based on what I learned from my rent roll study. So if the rent roll seems like it's off or really low, or there's a lot more vacant units, and your potential rent per month or your net revenue per month is drastically changing, like this to me would give me some questions. So why, you know, obviously the seller is getting the property ready to sell, right? They're averaging $144,000, but over the previous 9 months, their average was $132. So that to me seems a little bit interesting. All of a sudden over the last 3 months, we jumped $10,000 per month, which is absolutely significant on a deal like this. And so that's where you need to be able to study the rent roll and say, okay, do these numbers make sense, and carry that knowledge over to the T12. All right. When the loss to lease is a negative number, does that equate? The negative loss to lease is a negative number. So you see how your total potential rent decreases. Basically what loss to lease is, if market rent is $1,000 in the area and a unit, maybe the resident has lived there for 5 years and they're trailing the market rent and they pay $900, that one unit, you wouldn't bill the resident a bill for $1,000 and say, just pay 900. You're going to bill them for 900 and you're going to collect 900 from the resident. But in your accounting, you would have a minus $100 for that unit for a loss to lease. That means the loss compared to market rent today. How often do you find deals that have outlandish asking prices? Under the theory, a large buyer is specifically looking for that will generate a loss. All the time. There's deals all the time that that don't work out. You know, I think our rough numbers in Q4 of 2019, I think we had evaluated 1,000 deals. I think we liked about 20 deals and we put offers in on about 15. And I think we won one of those. So more often than not, the purchase price or the guidance seems to be a little bit crazy. So it's not, Brian, it's not outlandish. It's pretty typical, but that's why you need to be looking at a lot of deal flow in order to find the deals that work for you. Let me jump to the Q&A box and address some of these. Market rents are... So Clive, your question about putting value in what market rents are for their units, I absolutely agree with you. Looking at the actual rents they are receiving is important, but you need to make sure that their accounting makes sense as well. So if you take the gross potential rent minus the loss to lease, that should equal the actual rent that they collect. And so again, it's a story. You need to check the boxes and make sure that all of those numbers add up. And so if I'm comfortable with the market rent and I know their loss to lease is there, I should have exactly what they're collecting and all those numbers should make sense. How do you calculate the taxes if they're not evaluated at the time of sale? So that county would probably have a reappraisal process, and you will have to read what the reappraisal process is for each county that you're buying in. And I would say it's a good idea to call the county and ask how they handle it. I would also look on their website for, you know, changes in the tax liability for the asset you're looking at based on the reappraisal history of that county. What is the name of the other videos you mentioned? We'll make sure to get a link to the previous underwriting videos so you have access to those. Why do you consider lender reserves above the line? Because you are paying those out on a monthly basis. These are typical, it's just a more conservative approach. And so, you know, if in a scenario where you run into maybe a plumbing issue or a roof issue, you need to have some reserves to cover some of those expenses. That's why it's an above the line item. And it's just a kind of an industry standard. It's a red flag when Dan and I are evaluating other investments that we look at doing with other syndicators. If they don't have reserves above the line, it's just one way to kind of tease out some weakness potentially in the underwriting, or it doesn't allow for flexibility if something does go wrong, right? It's a business. There's things that happen, right? Viruses that come out, and it's always good to have a little bit more cushion than needing everything to go perfect, which it doesn't work that way. What are those items that could be a red flag for manipulating underwriting? Um, Red flags for manipulating underwriting. Well, from a T12 perspective, if the seller is giving you items that don't make sense, like this repair and maintenance number from the seller for this asset, that seems really low given the age of the property, the location, the vintage, the type of construction it is. So that would be some of the red flags. So one item are the historical numbers. And then from an underwriting perspective, if you didn't have reserves above the line, that could be a red flag. And if there was a massive disparity between any of the numbers, that would be a red flag as well. And I think we did a video last week actually about some of the red flags. So that would be another good one to watch. As a realtor and multifamily investor, what would you say is a safe cost for calculating both the buy and sell side commissions when underwriting? So large multifamily properties typically do not trade with a buyer broker. There is only one broker on the transaction. It is the seller's broker, and the seller will pay and compensate that broker. So you do not need to plan when you're acquiring a property. When you are exiting a property, we do have some exit assumptions as far as commission and title costs. So that's how that would work. Is market rent what you are getting? I think I've answered that question. How long does it take a good property manager review? All property managers are not created equal. I would think reasonably you should get something back from a property manager in like 24 to 48 hours. How long does it take to underwrite one deal? Well, Omar, I just did this underwriting, I would say in about 30 minutes. And that is kind of the basics. And then we move on. It takes more time to review and really hone in on the business plan than the underwriting aspect. And so once you get proficient, I would think the exercise to get the numbers populated is about 30 minutes to an hour. But then the time to review, the time to stress test the model is really the longer part of the process. So from a gut check of this deal, we can underwrite it and we can say yay or nay, pass or pursue, and take it a little bit deeper. And so 30 minutes to an hour should give you a good gut check on whether you want to pursue it or stop spending any time on it because it's a bad deal. What do you do when the rent roll isn't detailed and only has average rents? Bobby, that would be a kind of a red flag. So if you're buying from a mom and pop owner, I understand that, but theoretically, any decent seller, decent property manager should have a detailed rent roll of every unit. We have seen rent rolls with 600 plus units and they're all there. So there's no excuse to not have a detailed rent roll. And I would push a broker, I would push a seller to get you one. And I would also say, send me copies of all of your leases. We're going through a lease audit right now on a 250 unit property where we have people sitting in the leasing office looking at every single file to make sure that those rents in the lease match now what they provided in the rent roll. So detail, detail, detail. You should get it. Do you think a 30 unit is any different? Absolutely, a 30 unit is different than a 100 plus unit deal. The nuances, we've gone through those in part 1 and part 2 with our kind of rules of thumb. So I go into pretty good detail about that. So Nick, check out those links and Dan will get those provided. Find market rents in new locations. Richard, the best place use if you have access to CoStar, or if the broker has like a comp report for you. But the best way to do it is really, drive some assets that are like kind and go and tour properties and write down what fixtures and finishes they have and how much they're asking for. You can call on the phone. You can use apartments.com. You can use Rentometer. There's a lot of good sources online. How much more time, basic analysis to get your LOI? I kind of answered that one already, Nick, but basically if we feel really good with this initial underwriting and there's a ton of room for us to move with numbers, with expenses, we could get an LOI submitted in as soon as an hour. But again, we've gone through thousands and thousands of deals. So please don't think if you are new to this, you're able to turn it around that quickly. I encourage you to go through at least 100 deals to get a feel for how things work, what is in the market that you're looking at. And then I think that gives you the confidence to go and submit some LOIs and keep things moving that way. So let me jump back to the chat box. I've gone through everything in the Q&A and we are right on time here. We've got about 3 minutes left. So benchmark cap rate, we answered that. Great detail. T12, we're good there. Outlandish prices, we've got, there we go. In the chat box, Dan has provided part 1 and part 2. These are the rules of thumb underwritings that I talked about earlier. Vanessa, thank you for the thank you. We appreciate you being here with us. Underwriting strategies from last week, that link is in the chat box as well. Dan is including the link for your 2-week free trial. So check that out in the MFIN premium section. Daniel, thank you. Thank you for being here. I'm grateful to be helping. And we've got 2 minutes left. So any more questions you all have, feel free to ask them now. But otherwise, I'll turn it over to Dan to kind of wrap things up and take us home for the day.
Sure. Well, thank you so much, Danny. Everybody who's on, please give Danny some love and put him into the chat box. Let him know how much you appreciate him coming on and joining us today and sharing all these little golden nuggets as it relates to this underwriting. I really appreciate you coming on and spending this hour with our group here, and looking forward to having you on some future episodes as we continue to dive into some more of this underwriting for multifamily investing. All right. Well, for those of you who are on right now still, you can feel free to go over to the mfinpremium.com and register for your free 2-week trial. You can find out more information there on the website to find out what the program is all about and to join it. So thank you so much. And we look forward to having you on next week. And Danny, if you will switch your screen over there to the webinar page. And if you press refresh on the webinar page, it should be updated now, so you can actually see what's going to be coming up next week. So hopefully we have it updated. Okay, we don't have it updated yet, so that's all right. Next week we're going to have, we'll send out a link to everybody so you know what it is. Melissa's saying it's updated, so I don't know why it's not coming up. Let me actually pull up on my screen and see if it is coming up new. No, it's not updated on my side either, Melissa, so I'm not sure what's going on, but that's all right. So we'll actually send out a link to everybody so you can join us on next week's webinar, which is all going to be about the COVID-19, the coronavirus, and how it's been impacting multifamily investing. And so we'll dive into that and a lot of different topics on that next week. So thank you so much for being here. Thank you also, Danny, for being here with us as well. Look forward to seeing everybody next week.
Thank you all. Omar, shukran. Thank you. We'll see you.